The two most common questions we get are where are you buying property and why are you buying there now? I'm AJ, a director of Handle Properties. We've helped over 50 clients purchase investment properties over the last 12 months, achieving an average cash on cash return of 80%. And today, I'm going to take you through our strategy and our approach to finding the right suburb for the right client. When it comes to selecting the right suburb, it's not a one size fits all. After all, everyone's investment goals are different, so there's a number of factors that you need to take into consideration when you go about finding an investment that suits your needs. The first step is always the same. What are your goals? You need to identify where you want to take your portfolio and your life in the future. Now, importantly, when it comes to selecting that investment property, the first consideration is it a home or is it an investment? You need to be very clear around the both. Because if you're looking for a home, there are a whole host of other factors that might fit into the equation. For example, what suburb do you want to live in? Where do you want your kids to study? Perhaps how close is it to family and friends, so you can have that social network and outings that actually make life enjoyable. Whereas when it comes to investment, the considerations are different. It's more around what is an area that will give you the maximum return in the shortest period of time, whilst also making sure that you can afford the day-to-day expenses of holding that investment property. The second thing you might want to consider as well is once you've decided on home or investment, say you've chosen investment, you then want to think about your long to medium term goals. How many properties do you want between 5 to 10 years? What kind of passive income are you chasing over that time horizon? This will give you an idea of exactly where you need to get to over that medium to long term period to achieve all of your goals. Once you've nailed those two aspects, the next stage is to really have a better understanding of your budget and your needs. So, how much can you borrow today? Could you borrow 500, 600 or 2 million? Of course, depending on that number, your strategy could change quite drastically. So we need to make sure that we have that right point to get started. Then it's great that you can borrow 2 million, but you need to also consider how much can you afford to pay month on month to hold that investment property. Now, maybe you want to be conservative and you only want to set aside 50% of your savings to service the loan. You need to work out what dollar amount that actually is. Based on that month on month cash outflow, you'll then be able to decide what type of rental yield that you need to secure on the property that you're purchasing to hit that actual milestone. The worst thing you could ever do is buy property and 6 months later realize that you cannot afford to keep it and be forced to sell before you've been able to reap all of the rewards from the gains. So be very, very careful in this step. If you need help on this, reach out. We've got some calculators that we're happy to share with you. Thirdly, so now you know both your budget, you know your goals, you know how much you can afford. The last thing to get out of the way is really your preferences. Do you have a strong preference? Do you prefer a house or an apartment? Perhaps a townhouse? Make sure you have a good idea of what those are and which ones you're open to. Do you want a capital city or a regional town? Again, it comes down to comfort and your level of risk taking. Thirdly, do you want to invest interstate or does it need to be in a familiar location that you already know well? These are all considerations that you should put to mind and challenge yourself on, and try to speak to those outside of your comfort group or your immediate network so they can actually push your thinking. Because if you're stuck on buying just in a suburb that you know, you might be missing out on massive returns in another state or another city that you could have actually taken advantage of. Now, based on those three considerations we've talked about, we can actually get to step 4, which is the fun part. You can start filtering down now based on your budget, your needs, and what your cash flow requirements are, the basic nuances of what you need from an investment property. Now let's use an example. Let's say the budget is 600,000, the minimum yield is 5%, and you want an independent property. This is fantastic because now you've got your basic filters that you can apply across properties across Australia to have a good understanding of which suburbs you can actually be playing in. And I guess why this matters even more is as you get into different cycles of your life, if you're looking for commercial property versus residential, developments versus commercial, your needs change quite drastically, as well as the purchase price. So locking all of this in early will make the rest of the process just that much easier. Now we move on to step 5. We need to filter down on the national level based on your budget to seek areas that have both growing demand pressures as well as supply. Now, when it comes to demand, we want to see some clear markers that this suburb is about to explode. We look at factors such as time on market decreasing, the strong online interest from potential borrowers, more people attending open homes, properties selling faster than they need to. All of these things are demand pressures that we want to be not only available and there in the market, but we want to see it continuing to grow in the short to medium term. Now, this will help protect the pricing pressures and the price line or the price levels of your property. Now, when we get a bit deeper into each of these, we want to really see more people wanting to buy property in this suburb now than they did 12 months ago. Now, there's many available data sources online that you can look into to help you guide this. The second thing we want to make sure is that the time it takes to buy a property in this suburb is actually shortening, or rather the days on market are shortening. And we want that trend of shortening days on market to be available both in the last 3 months and 12 months. So what it basically means is, say in a suburb, if a property was taking between 30 to 45 days to sell a year ago, we want to see it selling within maybe 20 to 25 days now. And that really means that there are more people bidding and competing for properties, which means they're getting sold faster and faster. Now, if this pressure cooker continues for the next few months, what you'll actually see inevitably is an increase in price if supply stays constant. And now we're going to get to supply very shortly, so bear with me. The second thing you could look at is how many people are actually going to these open homes. How crowded is this interest getting? How many offers are getting put on properties? All of these are great indications of the demand that's getting pent up and built in this market. Once you have a good idea that demand is growing and is strong, the next thing you want to actually look at is supply. We want to look at the inventory of properties available in the market, and we want this to be shortening very quickly, similar to what we looked at for the demand side pressures. Now, when we think about inventory, the one main risk is new developments that are about to come into market. We don't want to buy in an area when there's 300, 400, 500 brand new houses about to be dropped in the next few months. Ultimately, what this will mean is that more availability to absorb that demand that we've fought so hard to find. And when that happens, pricing pressures are subdued and it may take longer for your property to grow in appreciation or capital value. Rather, we want to find areas that are really being choked from a development perspective, where the pipeline of new builds are really limited, which means as that demand pressure continues to increase, we'll actually see a correlation with house prices as well. The second thing is we want to make sure that the stock on market within these suburbs is really tight. We want stock on market to be below 3%. So that means if there are 100 properties available within a suburb, only 3 are up for sale right now. Now, ideally, we want it even lower, because that means the market's pretty tight and a lot of the properties are already occupied and unavailable for sale. We want to also see that as time goes on, the listings in the market are dropping. This means fewer people are actually getting to market to sell their property. So if the demand pressure is there, there's only one thing that can happen when there's more buyers and fewer sellers, which is the price actually goes up. And now, the next thing we want to make sure is that these housing pressures continue over time with the supply and demand pressures both there. And when we think about this, we actually want additional alpha or return on your investment. Anyone can find a suburb where there's good demand pressures. Few people can find areas where there's good demand and supply pressure. But we want to throw one more thing into the mix, and that is infrastructure. We believe that significant amounts of either private or public infrastructure investment can actually turbocharge the returns of the investment overall. So we're looking at things such as new train lines, new schools, new hospitals, perhaps private investment in a new shopping center nearby. All of these indications that might say that a property or a suburb, which is good now, would be even better in 3 to 5 years' time. Importantly, we don't want to buy after all of this capital appreciation and development is complete. We want to buy early in the cycle where we have confidence that it's going to go ahead, but prior to it being completed, when a lot of the pricing will get bedded into the market. Okay, so we've covered a few things around demand, supply, and infrastructure. Next is more of a suburb level. We want to make sure that the suburb itself is attractive. We look at things such as percentage homeowner occupiers. We want to invest in areas where there's at least 55% homeowner occupiers. Why? Because it means that the suburb itself is desirable to live in, and usually homeowners aren't as quick to sell properties on and off. Of course, the more that are homeowner occupiers means fewer rental properties available for market in this suburb, which means over time you can continue to increase the rent and improve your investment performance from a cash flow perspective as well. Then we want to also make sure that the average incomes within the suburb are high. This is important because if we're investing in suburbs where the average person is getting richer day on day, that means over time you can continue to increase the rental return or the rent that you demand for your property, and the people who live there can actually afford to actually keep up with it. The worst thing you can do is increase rent, have default on rent payments, and have to then work out that painful process of either catching up on rent with the tenant or trying to find a new one. Because nothing hurts you more as an investor than having a vacant property. Perfect. So now we've found a suburb. It's great. It's near infrastructure. The demand's there. The suburb itself is solid, but the next thing we want to make sure is that the rental yield is healthy. When building a portfolio, you need to make sure that you have strong cash flow available from your investments over a long to medium period. Why is it so important? Well, if you buy a property and it's costing you $3,000, $4,000, $5,000 a month to service, suddenly it's painful to hold this property. You need to take away from your lifestyle to fund this investment, but more importantly, it's actually slowing you down from saving for that next investment property. So even though it's counterintuitive and you think, oh wow, I've bought a perfect investment, it's so good, it's going to grow so much, it might actually be stopping you from buying property number 2, 3, and 4. And in the long term, the accumulation of this portfolio is what builds you wealth, not just that single property by itself. So we want to make sure that the cash flow is strong. We typically aim for cash flow of a cash yield on your rent of 5% or more. This will mean that you'll be able to at least bear the cost within a certain spectrum of month-on-month expenses. Of course, in the current interest rate environment with with interest rates around 6%, it's pretty tricky to get a positive cash flow investment that's going to tick all of the other boxes above. But at the very least, if you can get a yield of 5, 5.5%, 6%, your out-of-pocket expenses are minimal. And as interest rates decrease over the medium term, you might find that that property will very quickly become positive cash flow, meaning that you don't have to stump up money all the time to keep it. The next thing you need to make sure is if your rental yield's really bad and you buy 3 or 4 properties, you could really expose yourself to massive shocks when things go wrong. And look, in the journey of property investment, things eventually go wrong in one area or the other. Perhaps the garage door stops working on property 1, maybe the dishwasher on property 2, maybe for some reason there's a water leak on property 3. All of these unforeseen events could lead to cash drain from your pocket to hold that investment property. Now, as an investor, you've gone through the effort to pick an amazing property, so the worst thing would be to have to sell one to maintain these expenses. This is why a strong cash yield also protects you from that impact of anything that's unforeseen that might actually impact your day-to-day expenses. The final thing that we look for above and beyond all of these is population growth. Ultimately, demand might be high now, but it might drop off later. We want something that's going to actually sustain in the medium to long run. And a way of finding that is investing in areas where we think the population is going to explode. Now, this will protect us in the long term, ensuring that demand is robust and prices continue to increase. We don't want to be investing in a suburb that's a mining town where population's grown 30% now because the cost of resources is up and it's going to drop again later. Rather, we want to find areas that have strong medium to long-term positive growth. Now, we've talked a lot about the macro factors affecting the selection of the right investment suburb, but there's a lot of things down to a suburb and LGA level that you need to consider as well. Some of the things that we look at are things such as flooding. Social housing, is there a lot of community housing nearby? Will this impact the rent that you can demand or the safety to your tenants? Now, we're not adverse to social housing areas, but we just want to make sure that the places that we're investing in are desirable and can grow in the long run. Thirdly, is it at the corner of a busy street or somewhere where it's really going to be a little bit tricky to do much with the property in future? Or perhaps it's going to limit who will buy your property next. Then we care about things such as zoning and rules. We want to buy a good block of land where in the future you may be able to develop it into a duplex, a townhouse, subdivide it, etc. This doesn't mean that you need to do it yourself, but it just means that there's an other avenue or another reason that someone who looks at this property might choose to buy it. Then there's things such as land size. Typically, we prefer not to buy below 450 square meters. We want to buy 500, 600 plus. This just gives you more options in the medium to long run, but this is also dependent on your budget and your preferences for old versus new properties, but we'll get to that in a second. Then consider things such as aspect. Do you want a 3-bedroom house, 4-bedroom house, maybe 2 bathrooms or one garage or 2? All of these things matter on a suburb level because depending on where you're buying, perhaps the average family wants one thing over another, or maybe there's a supply imbalance for a certain aspect of property versus another. Then we come to the tricky one, really, which is the age of property. This is really personal, so there's no right or wrong. If all you want to do is build as much equity as possible, you probably don't need to buy a new house. You probably don't need to buy a house that's 5 or 10 years old. You can probably buy something 30, 40, 50 years old. As long as it's in good enough condition and structurally there's no defects that mean that you need to spend a lot of money to keep it going. What you'll be trading is for an older property, you typically get more land, which means more opportunity in the long run. But for a newer property, you probably get less land, but there's some tax benefits at the start. And it's maybe requires less month-on-month or year-on-year expenses, which means it's easier for you to maintain. It's up to you for which you choose. Personally, for where I am in my stage, age of property is not something I care about. I'm happy to go to an older house with a bigger piece of land because I'm trying to build equity over the longer run of 5 to 10 years. Then need to consider internal space. You might buy on an 800 square meter property, but it might be a tiny little house, even though it's 3-bedroom. You need to make sure that internal space is ample and comparable with other properties in the market, if not higher. This will eventually allow you to generate a higher rental yield on your investment. Finally, we don't want to overpay, so consider things such as cost per square meter to make sure that your price is on point with the market, if not below. Now, these might sound like a lot of factors. In reality, you don't have to nail each and every one of them, but a combination of all of these will help you buy an investment that's sure to succeed in both the short, medium, and long run. Now, if you're serious about buying investment properties and you want to dive more into this methodology or learn more about how we work with clients that handle properties, reach out to us today. We're happy to help. And ultimately, our goal is to help as many investors reach their goals towards financial freedom or purchasing that dream home as soon as possible. So if you're interested, reach out today. Otherwise, we wish you all the luck on your property investment journey.